Musk is preparing to take SpaceX public at a target valuation of $1.75 trillion. To put that massive number in perspective, that single valuation is worth more than every American defense contractor combined. The pitch to justify this price tag relies on science fiction. Management is selling investors on long-haul point-to-point rocket travel around the Earth, the colonization and industrialization of Mars, and a sudden pivot into artificial intelligence. At this scale, a standard IPO requires a massive influx of capital, trillions of dollars that few private entities can supply on their own. This capital will largely come from retirement accounts and pension funds, placing the stakes of this speculative venture directly into the hands of passive investors. The IPO is structured to utilize these retirement funds as the primary liquidity source for a company still navigating deep operational losses. SpaceX functions as a conglomerate of three distinct business divisions. First, there is Starlink, the satellite internet provider. It is highly efficient and turned a $1.1 billion profit in a single quarter. Then there is the space division, the part that actually builds and launches the rockets. That core business lost $662 million in that exact same three-month window. Starlink's small profit block is dwarfed by massive deep red blocks for rockets and xAI. xAI lost $2.5 billion in 3 months, pushing historic losses past $37 billion. AI costs accelerate this cash burn, violently cracking the foundation under $29 billion in debt. Buying shares of SpaceX means actively subsidizing an unrecoverable debt sinkhole, with the profitable internet provider barely covering the interest. To distract from those losses, the company's IPO prospectus relies heavily on artificial intelligence. According to their own filing, 93% of the company's total addressable market is now attributed entirely to AI. Yet their flagship AI product, Grok, holds a market share of roughly 3.4%. It underperforms rival tools so noticeably that Bloomberg reported SpaceX's own engineers have been slow to adopt it, choosing to use competitor products for their technical work instead. Instead of selling consumer software, their near-term AI revenue relies largely on a $15 billion a year deal to rent server space to Anthropic, one of the exact competitors beating them. That contract can be canceled by Anthropic with just 90 days' notice. A flagship product your own engineers avoid, backed by a rental agreement that can vanish in a single fiscal quarter, suggests this pivot is a corporate smokescreen designed to artificially inflate the valuation right before the initial public offering. A valuation built on fragile promises usually faces pushback from internal oversight. The SpaceX IPO disclosures reveal a pattern of corporate self-dealing with almost zero accountability. Last year, SpaceX used shareholder money to purchase $131 million worth of Cybertrucks from Tesla. They paid full retail price with no volume discount, using cash from one company Elon Musk controls to artificially support the sales figures of another. Beyond vehicle purchases, SpaceX and xAI carry more than $20 billion in high-interest infrastructure lease obligations. These debt agreements are tied directly to private investment entities connected to Antonio Gracias, a sitting member of SpaceX's own board of directors. Investors have no mechanism to stop this because of the company's dual-class share structure. Regular investors get Class A shares with 1 vote, while the CEO gets Class B shares that carry 10 votes each, granting him absolute control of over 85% of the voting power. Under this exact structure, public shareholders have no votes that matter and no meaningful ability to sue management. It legally strips away standard investor protections, turning the public capital into a consequence-free treasury for the CEO. A company with these financials and this lack of oversight typically faces immense hurdles from traditional Wall Street underwriters. In this case, the stock exchange altered its own framework. The NASDAQ stock exchange quietly rewrote its own listing rules specifically to accommodate this massive company. They introduced fast entry and eliminated the minimum free float requirement. This timeline shows the standard 3-month pricing discovery period violently compressed to a 15-day window. The stock skips its seasoning period, completely locking the market out of discovering the true organic price. By compressing the listing window, these rule changes ensure the IPO can proceed at its target valuation before the market has time to test the underlying math. The final mechanism of this trap relies on getting SpaceX stock directly injected into the prestigious NASDAQ 100 index immediately after listing. This diagram illustrates passive index investing. Billions in 401ks and pensions are automatically funneled into a central NASDAQ 100 reservoir, strictly required to track its contents. Adding SpaceX triggers a mandatory buying surge, automatically siphoning your retirement account to buy the stock. The true winners of this system are the early venture capitalists and Wall Street insiders. They use this manufactured wave of passive demand to quietly cash out their own shares at peak pricing. The SpaceX IPO is a legally sanctioned wealth transfer. It utilizes manipulated exchange rules to drain the retirement accounts of everyday workers in order to bail out a billionaire's failing financial machine.